Two people, same $10,000 investment, same 8% return. One pays $340 a year in fees. The other pays $22. Who ends up with more money in 20 years? It's the ETF versus index fund debate, and most people don't even realize they're not actually opposites. Meet Josh and Priya. Both want to invest $10,000 into the Australian share market. Josh buys a managed index fund from his bank. Priya buys VOS, an ETF that tracks the exact same index. Here's the twist nobody tells you. They basically own the same thing. An ETF isn't a rival to an index fund. Most ETFs are index funds. The real difference is how you buy them, how you trade them. Josh's index fund is bought once a day at a set price through his bank or fund manager. Priya's ETF trades all day on the stock exchange, like a share, through a brokerage account. The cost. Josh's fund charges 0.85% a year. That's $85 a year on $10,000. Priya's ETF charges 0.10%, just $10 a year. Same exposure, 8.5 times cheaper. Access. Priya needs a brokerage account and pays a small trade fee to buy in. Josh can set up automatic monthly deposits with no brokerage needed at all. So which one wins? If you want the lowest fees and don't mind a brokerage account, the ETF usually comes out ahead over 20+ years. That $75 a year gap compounds into thousands. But if you want to set and forget with automatic deposits and zero trading, a low-cost index fund can still do the job. Neither is wrong. The real trap is paying managed fund fees, the 1.5% plus actively managed kind, while thinking you're getting index-level performance. So now it's your turn. Are you Team Josh or Team Priya? Let me know in the comments, and if you want to run your own numbers, visit cleareveryday.com.